Hi, I'm Menaka Raman-Wilms, and you're listening to The Decibel from the Globe and Mail. With inflation, rising interest rates, the plunging stock market, and the rumblings of a recession, we've been hearing a lot about the not-so-great state of the economy. Many of us are worried about savings and even day-to-day expenses. But what we don't often hear about in this conversation is what's going on in the bond market. Bonds are conservative, relatively stable investments with modest returns. They're not flashy like stocks. But what happens in the bond market matters. 125 trillion US is tied up in this world. That's 3 times bigger than all stock markets combined. So why doesn't it get the same amount of attention?
The bond market is always a lesson in modesty. What it's saying is things are uncertain. It might be time to pay attention to what you can actually get, because the other stuff might be impossible at the moment.
Globe feature writer Ian Brown wanted to demystify this world. He's on the show to tell us about how bonds work, what bonds can teach us about the economy we live in today, and why the foundation they're built on may be cracking. This is The Decibel. Ian, thank you so much for joining me today.
It's a pleasure.
I want to just kind of jump into this world of bonds because it's pretty interesting and not something that I've really known much about before. I wanted to ask you, what did you know about the bond market before you started reporting on it?
Oh, I knew virtually nothing. Everybody talks about the stock market. The stock market is incessantly, right? It's going up, it's going down. We think that it's the true measure of our financial health, when in fact it's not. It's actually this whole other part of the economy, the bond market. All the stock markets in the world are probably worth $65 trillion. The bond market, it's 3 times as large, and it's way more indicative of the health of the economy. Because, knowing what people owe and how much money they're going to need to pay stuff back and over what a period of time, that's really important to the economy.
So let's actually talk a little bit about the bond market then and demystify it a little bit for those of us who are not as familiar. What exactly is a bond, first of all?
A bond is an IOU, and that's all it is. I mean, these things have been around since, the 6th century BC. When people were lending piles of corn and asking for 20% more corn when they got the corn back, from the person they lent it to. They're the foundation of the economy, way more than the stock market is. But all it is an IOU. If I want to borrow some money, I approach you and I say, I'm going to give you a bond for $100. It's an IOU for $100, and I'll pay you your $100 back by a certain date, and I'll give you whatever interest we agree to.
Who can issue a bond?
Anybody can issue a bond. The government of Canada issues them. They're the most stable kind there are. And the more stable, the more reliable, the more certain it is you're going to get paid back, the lower the return. The government of Canada is not going to go broke. So you're going to get paid. So over 10 years, you might make 2.5%, 2%.
So let's just really spell out the difference here then, Ian. How is a bond different from a stock?
A stock is something you buy to own a piece of the company. A stock, the upside on that is potentially infinite, and the downside is potentially zero. And that's how you get, through storytelling, essentially, something like Tesla, which was worth, last November, was worth around 1.2. Its market capitalization was $1.2 trillion. Today, it's worth half that. And Elon Musk, the great genius, is talking about what happens if it goes bankrupt. I mean, that can happen in the stock market. That doesn't happen in the bond market. The bond market, you buy the bond for $100, you get your 4% 10 years later, And it never goes any lower than that. It never goes any higher than that, but it never goes any lower. It's a sure thing, so-called. And bonds and stocks work together in the economy. So, if you have a financial advisor, your financial advisor probably has you 60% in stocks, or maybe 70%, and 30 or 40% in bonds. And what happens is, stocks can go up, 20, 30, 40%. You can get huge gains. And you'll only ever get that, whatever it is, 2 or 4 or maybe maximum 9% on a bond. But when things are good, the stocks go up and the bonds go down. And when things are bad, the stocks go down, but the bonds go up because they're a sure thing, right? You know you're going to get that money back. People say bonds don't make you rich, but they keep you from being poor. And they're the fallback position.
Bonds have been around for a long time. Of course, Canada started selling bonds as a way to raise money for the First World War. And they've been around ever since. So I guess what is it about this moment in time, Ian, that makes bonds worth paying attention to?
Well, for the first time in a long time, bonds have lost money. Since late last fall, the bond market has been dropping. Earlier we were saying if the stock market goes down, bonds go up. And, if the stock market goes up, bonds go down. Well, the stock market in the last, whatever it is, 8 months, 9 months, has lost nearly 30% of its value. And I'm using rough numbers here. You would have expected bonds to go up in that time. But instead, bonds have themselves dropped, 6%, 10%. Some bond funds have dropped 14%. And to a bond investor, that's a catastrophe. If I spoke to a bond trader who told me that if inflation goes up to 5%, he thinks losses in bonds, even in bonds, will be 20%. That really is a catastrophe. That means a whole bunch of people aren't going to be retiring, when they thought they were.
So the reason why bonds are going down right now too is tied back to inflation here. Can you kind of, really spell that out?
The Bank of Canada sets what they call the overnight lending rate. The problem is that when inflation is going up, the Bank of Canada has to meet inflation. It's got to give a return that is equal to inflation. Otherwise, the economy can collapse. So they constantly have to push rates up. And when rates are going up, every bond you buy is suddenly worth less today than it was yesterday. And inflation, was dropping pretty much between 1980, right, when the interest rate peaked at something like 22% in Canada. Your parents, talked about having a mortgage worth that at 18% and how harrowing that was. Well, that was from that time. But inflation has been going down ever since 1980. So for the past, whatever that is, 40 years, people have just been selling bonds. And it's been very easy to make money, because you've got that 4% bond and suddenly the interest rate is 2%, right? And you're worth more money. Suddenly now, interest rates are going up again because inflation is going up and the Bank of Canada is trying to fight inflation by raising interest rates because that sometimes works. So you've got this terrible problem now, whereas your 4% bond is now competing against interest rates that are 6%. That's not a good situation because that means you're earning less than inflation. So here am I sitting there with my sure thing that I thought was going to, make me 4% that I could live on. Suddenly it's worth way less than that.
This sounds a little bit complicated, honestly. Like this, there's a lot kind of to wrap our heads around here. But essentially what you're saying is when inflation goes up, the value of your bonds decreases. So that's bad. Is that fair to say?
Yes. This is what makes the bond market so hard to understand. When interest rates go up, bond prices drop. And nobody knows at this point how high inflation is going to go, whether they're going to be able to stop it by raising interest rates, how long that's going to stop, where they're going to settle out. And normally the bond market, which, is essentially a measure of everybody's debts, the bond market knows what's happening. It knows where things are going to go. But now, for the first time in 40 years, bond people who've really had no experience of raising rates. They've been used to this 40-year decline in interest rates. Suddenly they're facing this situation they don't understand. So they don't know what's happening. And when the bond market doesn't know what's happening, all those nervous, nerdy math guys, they get really upset because it feels like the foundation of the house is cracking. They don't like that at all. And that's the situation we're in right now.
Why is this the moment that is so confusing to traders? Why have they not seen anything like this before?
Well, first of all, interest rates we've been in this incredible period of prosperity, led by, there's been automation, there's been globalization, all things that have kind of come to a halt during the pandemic. Globalization's kind of a nasty word now. So for 40 years, they've had these declining rates. That's one thing. But we're also coming out of a pandemic. And nobody's experienced this in, nearly 100 years. Well, in 100 years since the Spanish flu, in 1918. So nobody knows what that's done to the economy. The government spent a huge amount of money that they've now got to, pay off somehow. That drives interest rates up. There's all this uncertainty. Historically, and there's not a lot of research on this, but there is some. Historically, it has taken countries and economies 20 years to recover from, a bout of the Black Plague or from a pandemic. 20 years. And that's 20 years of really slowly rising rates and slowly rising wages. And so we're coming out of 40 years of decline, of huge prosperity, declining interest rates, which have been easy to make money in. And we're coming into this, who knows how long period, where everything's the opposite, where it's much harder to make money, especially in bonds.
Okay, so before I let you go here, Ian, we've talked about a lot of the details here, but I wonder if we can step back and get philosophical again for a second about the bond market. It seems strange. This seems like such an influential market that we don't really talk about. A lot of us don't pay that much attention to. What do you think that says, I guess, about our society today that we don't really pay attention to this bond market? And can we learn anything from actually paying attention to the bond market?
Well, I think we can. I certainly learned that, it's funny. The bond market is always a lesson in modesty. What it's saying is things are uncertain. It might be time to pay attention to what you can actually get, because the other stuff might be impossible at the moment. We've got to recover from all this incredible change and the war in Ukraine, et cetera, et cetera. So it might be a time to be modest, and bonds might be saying modesty is traditionally a virtue. And it might be time for all of us to try a little, having lived so immodestly for so long. I talked to a guy who's a longtime writer at the Financial Times about this once. And he said, anybody who thinks about the market, and that's the stock market or the bond market, he said, the first thing you learn is humility. Because every day and every week and every year, in some way, even if you're the king of the universe, it proves to you that you were wrong. And he said that's the reason he likes to write about the markets, is that you're always trying to think about something that's bigger than you and that's always teaching you to think outside of the ordinary way you think. So there's this built-in humility to all the markets. And that's what the bond market is showing us these days, is that, people make a fortune selling, quote, intelligence and advice, and, they're inside that, they can control the market. They know it, and we can't. And bonds have reminded us of that fact, that in fact, this huge edifice we've built, this huge capitalistic system, it's based on a wing and a prayer. The wing is the stock market, and the prayer is the bond market. But it's just that the prayer, the bond market, is actually more reliable and is the thing we have to fall back to. And we don't like to think that way.
Ian, thank you. This was surprisingly a very illuminating conversation here.
Oh, it amazes me that it was illuminating in any way. But thank you for it's fun to talk about.
That's it for today. I'm Menaka Raman-Wilms. Our summer producer is Zara Kozema. Our producers are Madeline White, Cheryl Sutherland, and Rachel Levy-McLaughlin. David Crosby edits the show. Kasia Mihailovich is our senior producer, and Angela Pacenza is our executive editor. Thanks so much for listening, and I'll talk to you tomorrow.